investors, this is the Young Investor Guy. Welcome to the channel for investors. With horrendous economic data coming out regularly, people are losing jobs, stores are closing, businesses are shutting down, airlines are not flying, and hotels are not in business. Is there a second wave, and will consumers be spending? And the list just goes on and on and on. We can finally say that reality is beginning to settle in again, and the fear is back. And when the fear is back, people talk about the VIX. We often hear analysts and people talking about market volatility and monitoring the VIX all the time, which is why in this video, I'm going to talk to you more about the VIX, what kind of products are out there for trading VIX, and what kind of opportunities are out there when you have market volatility and how you can trade the VIX to capitalize on that and make some money. Now, before we start, I do want to forewarn you that trading the VIX and similar products are very risky if you do not know what you're doing. Even if you do know what you're doing, it is still a very risky product. But at the same time, high risk equals high reward, which is why some traders still like to do this. Please note that this video is for entertainment and education purposes only, and I'm not a financial advisor. Please be extra careful before buying anything and ensure to do your research and due diligence. I also do want to emphasize that the VIX should only be traded in the short term and not invested in the long term. Okay, so the video will be structured like this. First, I'm going to tell you about the popular products for trading VIX, who created these products, what the products are, and how they're structured. The popular products we're going to explore in this video are VXX, UVXY, and TVIX. Second, I'm going to tell you when are the best times to buy into volatility and into names like VXX, UVXY, and TVIX. Sounds good? Sounds good, young investor guy. At any time right now or during this video, please be sure to give this video a like. That would really help my channel and I would really appreciate it. So let's get started. Okay, first let's talk about volatility. What is the VIX Index? According to Investopedia, the VIX Index or Volatility Index is a real-time market index that represents 30-day forward-looking volatility market expectations created by the CBOE or Chicago Board Options Exchange. Now, you know, the CBOE is also the Center for Futures, Options, and Commodities Trading. Essentially, the VIX Index is derived from the S&P 500's options implied volatility. So when people are buying and selling the S&P 500 options based on the implied volatility, the risk index is able to measure the risk and market sentiment of the overall situation. This is why the VIX can be gauged as a measure for market risk, and people like to call it the fear index. Now, when people want to trade the VIX index, they could just buy VIX, right? And the answer is no, because the VIX is an index and not an actual product. So in order to gain exposure to the VIX index, you need to purchase products that replicate the performance of the VIX index. And these are usually done by purchasing products that buy futures contracts and options. Does that sound familiar to you? That's right, because you know familiar names like the USO also does something like this, right? The USO also functions in the same way by buying futures contracts that try to kind of replicate the price of oil or WTI crude. Now, the only difference is these products will be buying into the VIX, whereas in USO's case, they were buying futures contract of the WTI crude. Now, let's go over the top 3 popular products that try to replicate the performance of the VIX Index. The first product we're going to introduce is VXX, and this is Barclay's iPath Volatility Index. Let's take a look at its chart and its holdings. First thing I want to point out immediately is, if you look at the last 2 years, you'll realize a product like this one will always be downward sloping. From this chart, you can also identify at certain times when the fear is up, VXX will spike up. Now, I've circled a few of these peaks here. If you were to compare these peaks with the performance of S&P 500, you'll realize they have an inverse relationship. When the S&P 500 tanks, the VIX goes way up. But outside of those peaks, unless you can capitalize on these opportunities, you're bound to lose money because this thing goes down in the long term. That is also why I mentioned earlier, a volatility index product should only be traded in the short term and not invested in the long term. You're only trading the short-term spikes to capture these moments. Now, if we take a look at VXX holdings, we'll realize they're actively purchasing VIX futures contracts. At the current moment, we see that they're holding 2 months of futures contracts. 84% of the weight for the next month and 16% of the weight for the current month. Now, please note these weights and percentages are constantly being adjusted, being changed, being rebalanced actively. So it won't always be a perfect 84%, 16% split. But what you do know is when you purchase a product like VXX, it is buying into the futures contract of the VIX Index. Okay, now let's take a look at the second most popular product for trading VIX, and that is UVXY. UVXY is ProShares' leveraged version of the VIX Index. The reason why I use the word leveraged is because UVXY will try to attempt to replicate the performance of the VIX Index and then times it by 1.5 times. So for instance, if the VIX Index shoots up 10% in a single day, you can expect UVXY for the most part to go up by 15%. Now please note that the performance won't always be 1.5 times due to fees, expenses, rebalancing and adjustments and all that goodness. So in reality, it's not a perfect product, but it will try to replicate the performance as much as possible. Now, if we take a look at UVXY's chart, you'll realize this is a very risky product and it is very leveraged. Let's use these past dates as an example. If we look at UVXY prior to March, this thing was trading at just $15. This thing was all peaceful, trading at $15 and not doing anything until it got to March. It just exploded and overshot to 110. After it got to 110, you see we got more clarity on the market and things like that, and it retraced back to 60% of its value from the 110 and to about $45 on this chart. So you have to be aware that the range is just crazy. You could go from 15 to 110 and then back to 45. Now let's take a look at UVXY's holdings. Although this is subject to change at any given time, we can see that UVXY also holds futures contracts for the next month for the most part, and some of its current month's futures contract. What is different about UVXY than VXX is the fact that it holds index swaps. If you watched my previous videos, you will know that these leveraged ETFs and these leveraged products will always have index swaps in order to achieve the multiplication in the performances. So in the case of UVXY, since it was trying to replicate the performance of the index plus 1.5 times that, it will need to hold these index swaps. The third product we're going to go over is TVIX, and that is Credit Suisse's version of trading the Volatility Index. On a given day, the TVIX will try to replicate the performance of the VIX Index not by 1 time, not by 1.5 times, but by 2 times. At the same time, this product is very volatile, and that makes sense because it is supposed to track the Volatility Index. If you take a look at the peak in March, you will know that the gains are substantial. And the losses are also substantial if you buy at the wrong time. If we also look back a few years, we can also observe the major spikes in the short term, and those are the short-term opportunities. But in the long run, you'll see that these products are always going to be downward sloping. These products are always downward sloping due to contango issues. Contango happens when the forward prices are more expensive than the current spot price. So in other words, when futures volatility price contracts are more expensive than the current volatility contract prices, you will have a contango issue because these funds will actively need to rebalance its portfolio. So as you can see from earlier, they will need to buy these futures contracts at a higher price and sell the current ones at a lower price. And that means basically you're buying high and selling low. Now, if we take a look at TVIX's holdings, we can see that they're currently holding 80% of the futures contract for the next month and just 12% of the futures contract for the current month. Okay, that's awesome. So now we've gone over these popular products for trading VIX. Now the question is, when is the best time to buy into these VIX products? We all know the best time to buy into these VIX products is when the market has a lot of uncertainty and there's a lot of fear. Here are some situations. We know from the past that the VIX performed best when we have a market that's very volatile and have a lot of fear. We also know that VIX performs best when the S&P 500 index plummets. We also know that the VIX performs best when we get horrible economic reports. And this is under normal circumstances, because sometimes nowadays you have horrible reports and stocks still go up. So I would say under normal circumstances. And VIX also performs well when there's a political conflict, as well as when there's a lot of selling pressure and momentum. And the VIX performs worse when you have a market that moves sideways. And you also have VIX performing not well when there's clarity in the market. Also, when the S&P 500 performs well and it's quietly moving up. And also S&P 500, when you're in a bull market, the VIX won't perform well. Now here are some additional useful tips for trading VIX. Tip number 1, be aware of economic reports. A lot of market volatility comes from economic reports. So if we can anticipate and know what day, what reports are coming out, we can kind of somewhat manage our expectations as well as risk. For example, if I know tomorrow is the FOMC meeting and this man is speaking, well then you better buckle up your seatbelt because you know things are about to get wild when this man speaks. Or if I know on Friday that's the job report, you know things could get turbulent and things could be volatile in days like this. And the list goes on and on. It could be PMI numbers, it could be GDP numbers, it could be oil inventory, so the list goes on. There's just a lot of stuff you can kind of keep track of. And I like to have a calendar that kind of just keeps track of everything and what's happening on each day. So you know exactly what days you are expected to see the VIX to kind of rise and whatnot. Tip number 2, plan your entry point and plan your exit point. It is important to plan out your trades before you execute them. So, especially in buying stuff like the VIX, you will always need to ensure that you have an entry point and an exit point before you buy into it. In other words, before you buy, you should already know what price you want to get in at and what price you should get out at. Tip number 3, momentum is on your side. When you have a strong momentum in the VIX, be sure to ride that momentum. For instance, if there's a whole series of bad news coming in and the momentum just doesn't stop, you can expect to ride on that momentum. Since the VIX follows S&P 500 options, you may be able to find additional clues from how S&P 500 is trading, as well as volume and momentum over there. Also keep in mind that the VIX usually peaks when S&P 500 tanks. So that's an inverse relationship. Again, tip number 4 is you have to ensure that you're always trading these VIX and not investing in these VIX. If you feel like you've made a mistake on a trade, be sure you're able to get out at a price you're comfortable with. And again, this is because if you hold it for too long, the value will just keep decreasing. Tip number 5, volatility and spikes are short-lived. So if you miss out on a spike, chances are it won't come back until in a few months later. And during that time, if you're just holding the VIX product you have, the value will lose gradually over time. So again, that is why it's always recommended to have a plan B and know when to exit. If you haven't liked this video, please be sure to like this video and help to support the channel. I would really appreciate it. Investors and trader, what's your take on volatility? Do you think another volatility and another spike is just around the corner? Let me know in your comments down below. Thanks again for watching. I really appreciate your time, and I will see you next time.